What I have for you today is a very simplified example of what I think the Pillar 2 returns will look like. This is based on the document that the OECD published in December 22 and on the additional safe harbor guidance. But there's not a lot, I must say. There's some unclarity, and whatever has been written by other big firms is not more than repeating what the OECD has said already. But so let's work with this. Let's assume we've got an ultimate parent entity in Holland. We have subsidiaries in India, Australia, and Singapore, a production company, sales company, and service company. And our Singapore company has a Bermuda company, which I will use here as low tax company, not to hit on Bermuda, but simply as an example. Bermuda, I believe, is considering putting in a qualifying alternative minimum top-up tax, so that probably this example won't work in reality, but for now we'll use this as an example. So let us see what the reporting obligations for this will look like. First, I recall that in my last video I said, we can use our CBCR report as basis for the Pillar 2 report, and here I've just copied the 5 countries with the per country income, etc., etc. And I've done the same for the 5 entities regarding primarily their TIN numbers and their countries where they are, because that is what's being asked in the Pillar 2 report. And then just a reminder of this paragraph 34 from the safe harbor, preliminary safe harbor publication of the OECD, saying an M&E that qualifies for the transitional CBCR safe harbor on a jurisdictional basis is still subject to the GLOBE rules and the safe harbor rules, does not discharge the M&E group from complying with group-wide GLOBE requirements. Now, I don't know what that means, but I'll show you in the next pages. For example, an M&E would still need to prepare and file its GLOBE information return, including the information concerning the application of the transitional CBCR safe harbor. Now, there is no such information requirements in the December 22 document, so we will have to wait to see if that will be supplemented with additional boxes. Until that time, we will use our CBCR report. You can see here is the data for the reporting entity and the sending entity, and the blue is everywhere the boxes for what the Pillar 2 return will look like, and you can see most of the data can be copied from the CBCR report. So far so easy, but there is an issue of role. What is under 1.2 role? And then if you go to the guidance, first the OECD report on the Pillar 2 return gives you all the graphics, and then in the second half it gives you all the text, which is not very helpful, because then you've got to flip back and forth between the books. So I've simply put all of this into a PowerPoint presentation to make it easier. So if we look at 1.2.4, the relevant option for the role of the entity filing will either be the designated filing entity, the designated local entity, or a constituent entity. And I assume that we would here pick, as if it's the ultimate parent, that it would be the designated filing entity. And then there's also a drop-down list. I haven't copied the guidance here, but you need to pick between A, B, C, D, E for what kind of consolidated financial statements the ultimate parent has, your financial accounting data, and your currency. This one is easy. And here is just a short demonstration of what the guidance that I talked about in PowerPoint would look like. This is obviously the GLOBE information return that we're talking about. We just looked at how you file the reporting entity, and now we start with the group entity. You've got 4 boxes, this is what they say, and 1.3 you can see the general accounting information. Not that much to say, but still you need the guidance. And if you come to the ultimate parent entity, you can see there are notes where there are quite a few drop-down lists on what you have to report. So it helps having these together with the Excel file when you do your filing. A 10-second commercial. If you want to learn more about international taxation or transfer pricing, or treat yourself to an all-round update, or if you want your team to learn or stay updated, please visit my online courses. And now we can start with the actual report. Now, I assume that in all circumstances, also if you use a transitional safe harbor, would you have to fill in the data about the corporate structure, telling you how everything looks. Now, the ultimate parent entity, that is a short box, and you will just fill in what you need to fill in. All of this can be pulled from the CBCR report. So you would simply have to pick the name of the ultimate parent entity in a drop-down list of all the entities in your CBCR report, and that will then give you the lookup for the ultimate parent entity jurisdiction and the TIN number. You would have to declare whether it's a global, whether the jurisdiction is a qualified intermediate, the IIR rule, or whether it is a local one or some other regime, and what the status is for global purposes, etc., etc. When it comes to group entities, I assume under all circumstances that you will have to report all the group entities except for the ultimate parent entity, which is a little silly. I guess it's because you've already reported that, but here you can see I've taken this one out. But all the other entities do need to be reported. And you can also see that there is, I do about 2,000 lines because there are quite a large number of groups, or groups with a large number of entities, I should say. And obviously you want to be able to cover all of them. So how do you make the worksheet over so that you have oversight? Is simply to collapse them after a couple of lines. Excluded entities, one would assume, are not that many. So I have 50 lines here. And then finally, you would also do the changes in the corporate structure that occurred during the financial year. And I've just assumed here that we moved Bermuda from the Dutch ultimate parent to Singapore, and I assume that you would then have to report both. So you would have to say low tax code BM and its TIN number, etc., etc. The former ownership interest held in the entity before the change for the UPNLE was 100%, and then afterwards is 0, and then of course for Singapore before it was 0 and it was 100%. So you will have 2 lines per change at least. Let's go on. So we now come to our effective tax rate computation, and you can see 3.1 to 3.2 talk about jurisdictional characteristics and exceptions. So we have our 5 countries that we need to fill in. That's the jurisdictional characteristics, and they all have constituent entities. And then we talk about the safe harbor jurisdiction election, and which safe harbor do we choose. Now, I've in this case taken the simplified ETR test because that's the easiest to take, I believe, from the CBCR, and as you can see, Bermuda does not qualify for this. The total revenue is simply looked up because we have those tables from the CBCR that we've pasted into the first sheets, and the EBTEs, and then I've copied the tax accrued during the year, but obviously one would need to make some adjustments here because the income tax in Pillar 2 is not exactly the same as the income tax accrued during the year for the CBCR. So this one would have to check. And then you can choose for de minimis exclusion or substance-based exclusion. That's not going to work for Bermuda here because it's got more than 10 million and more than 1 million profit. And for all the others, I do the simplified ETR test. I assume that when you do the simplified ETR test, that then you would also have to fill in the calculation for the simplified ETR test, which you can see being done here. I assume that under the transitional one, you can use the CBCR numbers. You do not have to calculate the globe net income, which is a whole page with, I think, 26 rows to fill in per entity, and that you can use the income tax expense in the accrued tax, and that you do not have to use the adjusted cover taxes. And that more, and maybe the 331C and 214 could be the same for the transitional period, but I do not know. You then calculate your effective tax rate. You can see they've got A, B, C, and they tell you what to divide and multiply by what. And Bermuda ends up with the excess profits. And we calculate the top-up tax as being a full 15% of the 3 million, being 450,000. Now, you also have a table where you can indicate which entities qualify for the qualified domestic minimum top-up tax. Now, I assume in our example here that Bermuda doesn't have one, or whichever jurisdiction you have, which is the problem child in your group, does not have one. So what that means to me is you don't have to fill in the rest of the globe reporting in terms of numbers and all of those for Netherlands, India, Australia, Singapore, but you will have to do it for every entity and for Bermuda itself for all the other reports. So let's see what that look like. You would go to your jurisdictional computations, and the first thing here is you also work with subgroups, which you will have to look at in the guidelines as to what the subgroup is that you need, and then I assume that the subgroup would then be subdivided into jurisdictions, and then you do the detailed calculations of your net globe income or loss. You can see here you go from letter A, B, C to W and X. And you need to fill in all the company data for that. I've not done it here for the first four because I assume they fall under a transitional safe harbor. And then for Bermuda, there was not much to fill in because the financial annual net income will be pretty much close to the net globe income. There's no deductions to be gotten there. You would then have to go and do the computation of the adjusted cover taxes. And again, I assume that you can skip Holland to Singapore and only do Bermuda. But again, also you can see you go from letter A to letter Q in data that you need to fill in on a per country basis. And you need to come to your adjusted cover taxes. In this case, that'll be easy. That'll be 0. And then you can move on to your next table, and one of the next tables that I've taken here, which may be of interest for a lot of groups, is if you don't have a pure finance company like I have here in Bermuda, but you actually have a company with significant assets, significant employee costs, etc. For instance, a manufacturing group in a low tax country or enjoying a tax holiday or something like that, you will definitely want to fill in your substance-based income exclusion. I cannot do that for any of the companies here, not for Holland to Singapore, because they are already excluded, not from Bermuda because they had 4 employees and hardly any assets. But then you would also have to add per jurisdiction that you try to save from top-up tax your eligible payroll costs and all the other tables, to see how much you can reduce your net globe income to your excess profits. And from there, this is just showing you then need to do the same tables, not on a per jurisdiction basis, but on a per entity basis. There is some talk about whether there can be some relief for the per entity reporting. Frankly, I don't see that happening, not in the sense that formally maybe there can be fewer reporting requirements on a per entity basis, but in order for any business to report these things on a per country basis, they would need to calculate all the lines on a per entity basis, as far as I'm concerned as well, because the accounts are set up on a per entity basis and very rarely on a per country basis. So you can see you largely repeat here we're looking at the net globe income, and you can see you again have the 26 columns, 23 columns, because you only go to X, that you need to fill in. Obviously these will be looking like the Excel sheet that I've shown you before on the net globe income on a per country basis. Then you do the same with your globe income. You can see there's a lot of guidance on what to follow. You do the same with your adjusted cover taxes. And you will simply have to work through this on a line-by-line basis. Here you can see your globe income in a little bit more detail. Also the guidance that's given, not a lot of guidance. But I assume that this is where a company will have to go entity by entity and pull the data out from SAP or from Cognos or HFM, whatever it is that you're using. And since not, your net tax expenses, what is one line in your report here may be spread over 5 or 6 different accounts in your accounts, and you're going to have to add and deduct all of them together, and you're going to have to hope that what they contain is only net tax expenses, because if they also contain anything else, you would have to clear that out first before you can do this. And you're going to have to do this for the excluded dividends and for all 20, whatever it is here that you need to fill in on the rows and on the columns, and you're going to have to do all of that for every entity as well. And if you happen to be a group where you have 1,100 entities in your group, good luck. It is going to take some time. Again, I would like to hear more from you if you are preparing for Pillar 2 already, what you're doing, how you're doing this, any suggestions or comments on how what I've suggested here can be improved. If you have more information about what the OECD XML report is actually going to look like, so we know how we can split all of these things into our different Excel tables, do let me know, and we will come back to this when there is more information available. I look forward to seeing you next week. Bye for now.